Did you know that Australia's household debt is now among the highest in the world, surpassing even the United States and the United Kingdom? For years, Australians have stretched their budgets to the absolute limit just to afford a piece of the housing dream. But what if that dream is about to collapse? What if everything we've been told about the property market being safe is about to be proven dangerously wrong? Many experts are now warning that the housing market could be heading straight for a crash by 2026. The warning signs are quietly piling up. Interest rates are soaring, mortgage defaults are rising, and foreign investors are disappearing. But here's the twist. Most people aren't paying attention. They're caught in the excitement of record high prices, blind to the hidden cracks forming beneath their feet. In this video, we're diving into 10 powerful reasons why Australia's housing market could come crashing down. And one of them might shock you. Stick around, because understanding these reasons could help you protect your savings, your home, and your future. Number 1. Interest rate pressures. One of the biggest red flags facing Australia's housing market right now is the relentless pressure from rising interest rates. After years of enjoying historically low borrowing costs, many homeowners are now waking up to a much harsher reality. The Reserve Bank of Australia has been increasing rates aggressively to combat inflation. But these hikes are creating a dangerous ripple effect across the property sector. When interest rates rise, so do mortgage repayments. For many Australian families, this means they are now spending a much larger chunk of their monthly income just to cover their home loans. In fact, according to recent reports, over 1 in 4 Australian households are already experiencing mortgage stress, struggling to meet their repayments. This is a massive warning sign that the market may not be as stable as it seems. Think about it. What happens when thousands of people can no longer afford their homes? Some are forced to sell, others default. And when this happens on a large scale, property prices can spiral down fast. The scary part? Many recent buyers locked in at ultra-low fixed rates that are now starting to expire. As they roll over to much higher variable rates, their repayments could suddenly jump by hundreds, if not thousands, of dollars each month. This growing repayment pressure could push a wave of homes back onto the market, flooding supply just as demand weakens. It's the kind of scenario that can tip a market from stability into sharp decline. And it's a risk that's no longer just theory. Number 2. Wage growth is stagnant. While housing prices in Australia have skyrocketed over the past decade, wages have barely kept up. This growing gap is one of the clearest signs that the market is being propped up by debt, not by real, sustainable income growth. When the average person's income doesn't increase in line with the cost of living, something eventually has to give. Recent government reports show that real wage growth in Australia has been stagnant for years. In fact, after adjusting for inflation, many Australians are actually earning less than they were a few years ago. But during this same period, house prices have continued to soar, making homeownership feel increasingly out of reach for most people. This imbalance is creating enormous financial pressure on households, especially first home buyers who have stretched themselves just to get into the market. Imagine this. Your mortgage repayments are climbing because of rising interest rates, but your paycheck is staying the same. How long can that really last? For many, it's already becoming impossible to keep up. When wages don't grow, it limits people's ability to continue pushing house prices higher. The pool of buyers who can actually afford today's inflated prices is shrinking. What's even more concerning is that this isn't just a temporary slowdown, it's part of a long-term pattern. Without strong wage growth, the housing market loses one of its key pillars of support. Eventually, when people simply can't afford to pay more, prices have nowhere to go but down. And if this wage-price gap continues to widen, it could be one of the main triggers for a housing market crash in 2026. Number 3. Declining consumer confidence. Another critical warning sign flashing across Australia's housing market is the sharp decline in consumer confidence. When people stop believing that property prices will keep rising, the entire market can shift fast. Confidence isn't just about feeling good, it's about whether people are willing to spend, invest, and take on big financial risk like buying a home. According to recent consumer sentiment surveys, Australians are becoming increasingly pessimistic about the economy and the future of the housing market. More and more potential buyers are deciding to wait, fearful that they might buy at the peak and be left holding a falling asset. When this mindset spreads, demand starts to dry up and prices begin to soften. Think about it. Would you rush to buy a house if you thought it might be worth less next year? Probably not. And that's exactly what's happening. Reports from major banks show that new loan applications have already started to slow, and open house inspections are seeing fewer visitors. This kind of hesitation can snowball quickly. When buyers step back, sellers often panic and lower their asking prices to attract interest. Consumer confidence is the invisible fuel that keeps the housing market running. Without it, the machine grinds to a halt. What's especially dangerous now is that this decline in confidence is being driven by multiple factors: rising interest rates, stagnant wages, and fears of a broader economic downturn. When people lose faith in the safety of housing as an investment, it can trigger a chain reaction that pulls the entire market down with it. And that's exactly the risk Australia is facing right now. Number 4, rising mortgage defaults. One of the most alarming signals that a housing crash may be looming is the steady rise in mortgage defaults. When homeowners start missing repayments in large numbers, it's often the first real crack before a market collapse. And right now, those cracks are beginning to show in Australia's property landscape. Recent data from Australian financial institutions reveals that mortgage arrears are quietly increasing. More homeowners are falling behind on their repayments as interest rates climb and the cost of living surges. Many of these homeowners took on large debts when rates were at record lows, expecting stable repayments. But with those fixed rates now expiring, they are suddenly facing sharp jumps in monthly costs they simply cannot afford. Imagine waking up to find your mortgage payment has increased by several $100s overnight, while your salary has stayed the same. For many Australians, this is no longer just a fear, it's their reality. And when too many people default, banks are forced to repossess and sell these homes quickly, often at reduced prices, to recover their money. This increases the number of properties on the market, driving prices down even further. It becomes a vicious cycle. Falling prices trigger more panic selling, which floods the market and pushes prices even lower. Mortgage defaults are not just a financial issue. They're a signal that the system is starting to crack under pressure. If this trend continues, we could see a wave of forced sales that flood the housing market by 2026, dragging prices down sharply and shaking the very foundation of Australia's property boom. Number 5. Overseas investment is shrinking. For years, foreign investment has been one of the key drivers pushing up Australia's property prices. Buyers from countries like China, Singapore, and the United States poured billions into Australian real estate, often snapping up high-end homes and inner-city apartments. But that powerful tide of overseas money is now pulling back, and the market is starting to feel it. Recent government reports show that foreign investment approvals have dropped significantly, particularly since stricter regulations were introduced. At the same time, global economic pressures like rising interest rates in other countries, stricter capital controls, and international uncertainty are making foreign investors think twice about parking their money in Australian property. What does this mean for the local market? Simple. Less demand means less competition. When foreign buyers step out, it removes one of the biggest sources of price growth, especially in major cities like Sydney and Melbourne. Developers who previously relied on offshore interest are now struggling to sell new properties, and this could push them to cut prices just to move inventory. Think about the ripple effect. A decrease in foreign investment doesn't just lower demand, it shakes confidence, slows construction, and even impacts rental prices. When a market loses a major support like this, it can create a dangerous vacuum that drags everything down. If overseas money continues to retreat at the current pace, it could leave the Australian housing market overexposed and far more vulnerable to a correction or crash by 2026. This is a trend that too many people are still ignoring. We put a lot of heart and energy into creating videos like this to keep you informed. If you found this video valuable, please hit that subscribe button. It's just one click, but it means the world to us. And tell us in the comments, do you think the housing market will crash or will it bounce back? We'd love to hear your perspective. Number 6, oversupply in key markets. One of the silent threats creeping up on Australia's housing market is the issue of oversupply, particularly in major cities like Melbourne and Brisbane. For years, developers raced to build high-rise apartments and sprawling housing estates, driven by the belief that demand would always outpace supply. But that narrative is starting to crack. Recent data shows that in certain pockets, especially the inner-city apartment markets, supply is now far exceeding demand. Thousands of units sit empty or unsold as developers struggle to find enough buyers or tenants to fill them. This growing stockpile of available properties is a serious warning sign, because when there are too many homes and not enough people to buy or rent them, prices are forced to drop. Picture this: developers and investors who overcommitted during the boom now facing the reality of vacant properties and falling rents. To recover their investments, they often start slashing prices, which puts further downward pressure on the entire market. And as more properties hit the market in desperation, buyers begin to expect bargains, accelerating the price drop. Oversupply doesn't just affect prices, it impacts rental yields, pushes some developers into financial stress, and can even slow future construction. It's a domino effect that weakens the housing sector from within. If the current oversupply trend continues unchecked, especially in key urban hubs, it could flood the market by 2026, driving a sharp correction that many aren't prepared for. Oversupply is one of those silent risks that creeps up slowly but can trigger rapid and painful consequences when the balance finally tips. Number 7. The hidden impact of population slowdown. Population growth has long been a powerful engine fueling Australia's housing market. More people mean more demand for homes, whether to buy or rent, and that demand pushes prices upward. But now, a hidden and less talked about factor is emerging. Australia's population growth is slowing down significantly, and this slowdown could have huge consequences for the property market. Recent statistics show that net migration, the number of people moving into Australia minus those leaving, is dropping sharply. This is due to a combination of tighter immigration policies, global uncertainties, and pandemic-related border restrictions. At the same time, birth rates are declining, meaning fewer new Australians are entering the market naturally. Put simply, fewer people are needing homes. Why does this matter so much? Because a shrinking or slower growing population directly translates into less demand for housing over time. When fewer new residents arrive, the pressure to buy or rent property eases. Developers may find it harder to sell new builds, and existing homeowners may face a stagnant or falling market. Most importantly, this population slowdown is a slow-burning threat. It doesn't cause immediate crashes, but steadily chips away at the fundamentals supporting high prices. As demand weakens, price growth slows and can eventually reverse. Many analysts believe this quiet shift will be one of the key reasons behind the predicted housing market crash in 2026. It's a factor that often flies under the radar but has the power to reshape the market landscape entirely. If you're watching the housing market, this is one trend you cannot afford to ignore. Number 8. Government intervention backfiring. Governments around Australia have tried to support the housing market, especially for first-time buyers, through various grants, subsidies, and low-deposit loan schemes. While these policies were designed to make homeownership more accessible, many experts now warn that they might actually be fueling the problem instead of fixing it. When the government injects extra money into the market, it can create artificial demand. For example, first home buyer grants encourage more people to jump into the market quickly. But this increased buying power often leads to sellers raising their prices, knowing there's more money chasing the same number of homes. The result? Prices go up, making homes less affordable in the long run. Furthermore, low deposit loans allow buyers to enter the market without saving a large deposit, but this can also lead to higher financial risk if property prices stall or drop. Many of these buyers may struggle to keep up with repayments if interest rates rise, increasing the risk of defaults and forced sales. There's also the unintended consequence of distorting market signals. Instead of letting prices adjust naturally based on true supply and demand, government incentives can create bubbles in certain areas. When the support fades or is removed, these bubbles can burst, leading to sharp price corrections. In short, while government programs aim to help, they may be unintentionally inflating prices and increasing market vulnerability. If these policies continue or expand without careful planning, they could contribute to the crash experts predict for 2026. Understanding the full impact of government intervention is crucial if you want to see where the housing market is truly headed. Number 9. Rental market volatility. The rental market plays a huge role in Australia's overall housing landscape, and right now, it's showing signs of serious instability. Over recent years, rents have surged dramatically, especially in major cities like Sydney and Melbourne. While this might seem good news for landlords, it's actually creating tensions that could ripple back into the housing market and add fuel to a potential crash. Rising rents put a lot of pressure on tenants, many of whom are already struggling with higher living costs. This strain leads to increased demand for rent assistance and government support, and can also trigger social unrest and calls for stricter rental regulations. Governments may respond by introducing tighter rental controls, such as rent caps or stronger tenant protections, which could reduce the profitability of rental properties. For landlords and investors, this means rental income could become less reliable or even shrink. When rental yields decline or become unpredictable, many investors start to reconsider their investments in property, choosing instead to sell or hold off on new purchases. This withdrawal can reduce demand in the housing market, causing prices to stall or fall. Additionally, if tenants face rising rents and economic uncertainty, more people may delay buying a home or struggle to save a deposit, reducing first-time buyer demand. At the same time, some homeowners might rush to sell rental properties that are no longer generating strong returns, increasing supply on the market. In essence, the volatility in the rental market adds another layer of risk to Australia's housing market. If these trends continue, rental market instability could be a key trigger in the predicted housing crash by 2026. Number 10. Global economic uncertainty. Australia's housing market doesn't exist in isolation. It's deeply connected to the global economy. And right now, the international economic landscape is anything but stable. From ongoing geopolitical tensions to supply chain disruptions and fears of recession, these global issues are creating a perfect storm of uncertainty that could seriously impact Australia's property market. Economic uncertainty abroad affects Australia in multiple ways. For example, when major economies like the US, China, or Europe face slowdowns or financial crises, it often leads to reduced foreign investment in Australian property. Investors become more cautious, preferring safer or more liquid assets. This withdrawal of overseas capital removes a key source of demand and liquidity in the market. Additionally, Global inflation and energy price shocks increase costs everywhere, from building materials to household bills, putting pressure on Australian families and developers alike. Combined with rising interest rates, both locally and internationally, this creates a challenging environment for borrowing and spending. Supply chain issues also disrupt construction projects, delaying new housing supply and adding costs, which can squeeze profit margins and investor confidence. On top of that, trade tensions and geopolitical conflicts can trigger market jitters, leading to sudden sell-offs or reduced economic activity. Australia, being a highly trade-dependent nation, feels these shocks keenly. When uncertainty is high, buyers and investors tend to hold back, waiting for clarity before making big financial moves. This hesitation slows down market activity and can contribute to price corrections. In summary, the tangled web of global economic uncertainty is a powerful force that could accelerate the housing market's decline by 2026. It's a risk factor that affects not just Australia, but economies and markets worldwide. And it's one that every homeowner and investor should watch closely. As we've seen, Australia's housing market is facing a perfect storm of challenges that could lead to a significant crash by 2026. From rising interest rates and stagnant wages to shrinking foreign investment and oversupply, these factors aren't isolated. They all interact to weaken the market's foundation. Add in a slowing population growth, government policies that may be backfiring, rental market volatility, and global economic uncertainty, and the outlook becomes even more concerning. What makes this situation particularly worrying is how many Australians remain unaware or overly optimistic, caught up in past growth trends and the assumption that property prices will always rise. But the facts tell a different story. One where affordability is declining, financial pressure is mounting, and confidence is waning. If you're thinking about buying, selling, or investing in property, it's more important than ever to stay informed and be cautious. Understanding these 10 reasons can help you make smarter decisions and protect your financial future. If you found this video insightful, please like, subscribe, and share your thoughts below. Your perspective matters to us. And don't forget to check out our other videos for more updates and tips to navigate these uncertain times.